Everything seemed to be bad timing. It was a particularly bad time. It was a bit of a black swan event. I remember sitting there. We knew COVID was around. I think it was the Formula One weekend where the government called a lockdown. We just purchased a property just a couple of months prior. Started to really slow down that time on when we had the lockdowns.
Bryan Green, my owner guest today, from 10 townhouse developments to now a buyer's agent for the property investors. So can you tell us, before we started, quickly introduce about yourself for people who don't know you?
Thanks, Tom, for the introduction. Bryan, I've just turned buyer's agent from property developer. My business is Asset Purchase Partners. We're looking forward to jumping into the buyer's agent sphere.
At the beginning, before the buyer's agent, the 10 townhouse developments, you have a high-pay PAYG job, being the corporate senior manager. A very stable life. Why you start to quit a job and then sign up something very risky, which is property development, and then even something more risky is quit a stable job and then start your own business.
It is very risky to quit your job. What it came down to is that I felt like I wasn't giving anymore. I was just being there in a job, which I had security blanket around me. There was a point in time where you just got to say, look, I've got to take this blanket off. I've got to go out on my own. I've got to do things. I like building. I like developing. I like giving back to people. I like seeing and investing my time in others to make sure that they can get somewhere as well and not just stagnate through life and just have a regular PAYG job.
Bryan, I was your broker for the 10 townhouse developments, having the privilege.
Yep.
When we're reviewing a project, I'm still very curious because why a lot of your neighbors only get 6 townhouse permit, but you managed to get 10?
Good question. You're right about the 6, and a lot of them did get sick. We had a really great team around us at the time. I joined up with a very experienced developer and a really good A team around us. So we had town planning, architect. Put it in a nutshell, we knew what we could get. We knew the restrictions on the land. We knew the zoning on the lands. And we knew that this particular piece of land, the best and highest use was going to be the highest yield, and we knew how to achieve that.
Bad timing, the sooner you get a signs, COVID started, outbreak. So tell us a little bit more what difficulty you encounter for this project and how you go around it.
Everything seemed to be bad timing, no matter what stage we were in the development. Initially, we thought it was a bit of a black swan event. I remember sitting there. We knew COVID was around. We knew it was coming to Australia. I think it was the Formula One weekend where the government called a lockdown. We just purchased the property just a couple of months prior. It started to really slow down that time on when we had the lockdowns. Highly risky project, but once again, we had great people around us to help navigate our ways around it.
So if you don't mind walking us through the different stages, like the land banking stage, the pre-sale stage, the construction stage, the residual stock stage, would you mind walking us through what kind of major challenge and milestone you achieve?
So we were lucky to deal with a pretty good vendor when we picked up the site. We knew it was a good site. We knew we were paying fairly well for what we were anticipating going forward. So we were lucky enough to get a 12-month settlement. We had a 30-day due diligence period in there as well. There wasn't a huge amount of competition with that site for different reasons. We took that whole 12 months to be able to go through the town planning stage, the architectural drawings, things like that. So we utilised the most part of it before we had to take out any finance. Unfortunately, as I alluded to before, COVID hit. It was sort of a few months after we'd taken on the contract, so it went unconditional, so no matter what, we had to purchase it. Because we didn't have plans and permits, because everything started to contract, which we didn't anticipate. After that, we had to go to a land banking loan to settle on the property. So lucky for that part, we had a good broker that saw us get through that stage. And to take on a property worth 1.3 million wasn't really easy for us at the time either. So that was that stage. We probably took that on for the next 6-8 months, maybe even more, waiting for the permits to come through. Once the permits came through, then we pivoted to the construction loan. Went through the construction period. In the meantime, we had some pre-sales. At the end of the build, we then went to a residual stock loan, once again of your doing, which was a very challenging time to get residual stock. And there was a few important things that we had to control just to be able to get that loan and the LVRs on that loan. And one of those included having some really good conversations and relationships with some good valuers who actually came in and valued it, not just on comparable sales, but what we needed them to come in at, and which was fair, so that we were able to get that refinancing done so we could then move on to the sales period.
So there's a lot we can share the finance strategy for all property developers. Number one is that we always prepare bank solution and non-bank solution for any upcoming development sites, because we just prepare for the best and worst case scenario. So if with a build contract permit, we get enough pre-sale and enough time, we go to the bank. But if not, like this case happened, where COVID came, all the sales slow down, we'll have to prepare for longer wall, then we'll go to non-bank. And then also when it comes to residual stock, if the pre-sale go faster or the sales activity go fast, then we don't need any residual stock. But sometimes for tax benefits, developers also retain 1 or 2 rather than doing residual stock with high rate, short tempo, sort of bind it themselves, apply it for 30 years, and then get the equity out, 80% maximum, and then just sit there and wait for 5 years or more.
And that's correct, and that's what we did in the end.
Valuation, another fight for developers, because you have to do multiple valuation. For a lot of construction sites, valuer got different opinion. They have different insurance scheme or stress behind the PI insurance. One value very high, and then 2 years later, they change their opinion, they change the data. You sort of have to speak to different valuer and utilize the industry relationship to fight for the best result for the customer.
And that's what we had to do. We had to really nurture that relationship with the valuers, and make sure that we were doing our part as quickly as we could, making sure that we could get that uplift to make sure it could happen in a decent period of time. And once again, that's where the team came in as well, to make sure we got those valuations where we needed them to be.
I wouldn't say COVID is the only reason for a lot of development sites to slow things down. So it means that you have to comfort the lenders, you have to comfort the buyers, you have to comfort the agent, investors, and everyone. So how's your experience on that? So many communication.
It was critical to have that communication.
Even pay for the renewal for the loan.
Because we weren't the only stakeholder in the venture. We had joint venture partners or money partners come in. We had the bank loans come in. We had ourselves in there as well. There were numerous parties at different levels which needed to be managed right throughout, keeping them up to date, giving them timelines and managing their expectations, which was probably one of the most important things, is managing their expectations in that developments don't happen perfectly. Always something that goes wrong or gets delayed for different reasons. When you go in at the start of the project, an investor will say, I just want to be in for 18 months or whatever the time period is. Once you start realizing we're going to tick over that 18 months, we might go to 20, 21, 22. We have to start then managing from the investor side point of view, which is where finance comes in, the terms of the loans as well, letting the lenders know that, look, we're going to go over here, this is where we think we're going to be, rather than just sort of like sitting back and doing nothing and then get penalised at the end. Finance did a lot for us, very, very proud in that whole field.
Bryan, what's the best decision you made doing this project?
The best decision for me was actually doing the project. There was no one small decision. It's a combination of a whole heap of decisions that go in with it. But from a macro point of view, the best decision was actually doing it. The learnings is like, it was a massive curve. You get a whole heap of learnings and then you go out and do it, and then it's on the other side. It was a steep learning curve all the way through.
So theory is always theory unless you practice.
The theory and the practice got nothing to do with it, because you got so many moving parts, everything's so dynamic. You did have COVID, you had consultant, you had builders going through, and not everything marries up exactly at the timeline that you want. The best decision was doing it, just so simply we can learn from it, learn from this very first project, and it was a fairly large one to begin with. In turn, it's given me a lot of learnings and education to then apply it into the field that we've also extended into, aside from the development.
So Bryan, if you have the time again to do this project again, how would you do it differently?
Yeah, I could do a lot differently, actually. I would still purchase the site, I'd still go ahead with it. That we would manage certain functions within that site. It was on a fairly busy arterial road. When we assessed the site, we assessed it only from a developer's point of view. So this is what we can do, this is how it's all going to go. We'll have the driveway here, drainage, building, all that sort of stuff. What we probably failed to recognise was the end process and the people that are buying it at the end. So there were little facets of where we probably didn't take that into enough consideration whilst we're in the planning stage. It wasn't until at the end of it that we sort of thought, well, okay, so we could have done things a little bit better. Busy road, pretty noisy, things like that. Not just setbacks, but noise controls within some of the units. We probably could have been a little bit more proactive in thinking of the end buyer. So a lot of learnings in that.
So that's all the experience you can apply to the next project.
Exactly. Not only to the next project,
yeah.
but also to the next acquisition that we do for our client. Knowing these things, we can then apply that and impart that knowledge and say, look, we think your valuations might not stack up to where you think they might be if you buy in this location or that location, not just to do with roads and noise, all sorts of other general.
From my experience, if you knew a buyer's agent who have property development experience before, it's very outstanding already by itself. Property developments, especially at that scale, you have to apply a lot of different knowledge and skill sets to solve the problem and see where the value add is at the end of the day and who is willing to pay that price at different time of the market to buy that stock. A lot of wisdom in that. It's like the special force in the inventory, normal inventory union. You have to know everything.
And if this doesn't go right, then we go to step B.
Yeah.
And if plan B, we go to plan C. It's the same with development. We need exit strategies. And one exit strategy is not good enough. You need multiple exit strategies. And it's the same way we approach it to an investor buying a regular investment property. What goes into the different exit strategies, which will differentiate us from your regular agent just wants to purchase a property and then move on.
Being involved with different structure, sit down with your tax agency or tax planning, tax advice, discuss about this distribution and all that. And surprisingly, many buyer's agents don't even know how trust works.
So we don't want to encroach on giving financial advice or anything like that, but there are definitely structures that you can put in place for protection and for building your assets down and then distributing later to your family. We had an excellent accountant on board, put all that into place and has taught us a fair bit about that.
In the end of the day, property investment, just like investing in finance, by just putting a couple of properties as the product. So Bryan, I want to ask you now, you've done the heartbeat, which is property developments. So I imagine it must be so easy for you to be a buyer's agent. The client should be just coming in, they should feel blessed that you're a solid buyer's agent, you went through much harder stuff. So what's the property selection philosophy now you have, given the development experience you have now?
So with the experience that we've taken from the development, we like to apply the same checkbox criterias and things like that. Every client is going to have a different brief, so we need to meet that brief. Not only do we want to meet that brief, we want to give different strategies of how to, if they want to develop later on down the track, if they want to stick a granny flat on the back, if they want to subdivide, knock down, renovate. We need to present all the options going forward. With the knowledge from the development side, we can feel very confident in advising of what they can do, present all the options to them, have different cash flow charts for different strategies. And we sort of feel that by doing that gives our client a lot more things to think about while they're planning their next 10 years or whatever the phase that they're trying to plan. They've got a lot more options in there.
As someone who got a development experience, you can see the full potential of a property.
Correct.
Rather than someone who don't have the experience, they can just sell this to the clients and then just hold it and then pray for 7 to 10 years it will double.
We can see the potential, but we also know because we're still developers ourselves, we're certainly not selling our product. It's a completely separate thing. We know what the government's doing as well. We know what the government plans are. We know the intricacies of what the government's trying to do, how they're doing it, in what different states, what they're trying to do over there. New South Wales is doing something different from Vic government, which is doing something different from Queensland government. We're quite abreast of all those processes and changes that are happening. It does give our clients a much better edge.
Most buyers agents are not trained. So what's the advantage of knowing the upcoming new rules for the planning? Does that mean that the property you selected for the customer is going to grow more or more exit strategy?
It's going to come down to valuation from the very beginning. So if we know there's value add potential, they're going to be able to extract the equity much, much faster than just your regular house and land package. If you give them more strategies and more options for the best way forward.
So Bryan, there's so many new buyers agents in the market now and more buyers agents every day marketing themselves on social media. How can a normal property investor select and make the right choice of the buyer's agent and suitable for them?
It's really going to come down to experience and being in the field and presenting the clients with better options than what's just available on your regular realestate.com or domain. Most buyer's agents have relationships with agents on the ground. You get off market as well. It's the experience and the breadth of what you can do with a property. What we would do is we would discount properties immediately if it doesn't suit the brief or if it's not part of the client's strategy going forward, rather than just sort of saying, look, we think it's good value because the market might lift. It may not lift. So there's a lot of data behind what we do as well. So there's a lot of knowledge in site selection, but at the micro point of view, we use a lot of data comes in underneath that. So we are able to present more options.
And certainly the software and the data you use are for the developers level. And when it's being applied to normal house investment for property investors, they should have more peace of mind. It's like more bulletproof.
We integrate it together. Yeah. So we use the data software just to do with the real estate at suburb level, but we also integrate the developer software in on top of that, where it's got the different zoning easements, planning schemes, things like that.
Sounds almost like using a bulletproof military level of to drive the Uber Eats around.
It'd be nice to think about it that way.
It's definitely safe. Talking about Victoria market being not very optimistic for quite a few years, you mentioned that you see some data to prove that Victoria market is coming back. Would you mind sharing a bit of that?
Vic's been trashed for a long time, probably since COVID, simply because a lot of it started with investors wanting to get out. During COVID and after COVID, the market didn't really move. The predominant market, some markets, sub-markets moved, but a lot of the markets, and the perception was that markets weren't moving, land tax was going up, there was a lot of fear-mongering, people wanted to get out. So that's what happened. So Vic's got a pretty bad reputation over the last 5 years or so. What the more sophisticated investors and people that look into the data a lot more have seen is that VIX started to move. It already is moving. It's not like it's just started. There's certain pockets which have already started to move. So the smart money's already in. We use the data to be able to tell not only what's been happening prior to these suburbs, you've got spillover suburbs as well, but the forecast of what's going to happen. And we use a lot of different metrics, things such as building approval, how much land is around, different zonings, stock on market, the supply and demand, the trends of those sorts of things, stock on market, which is going to increase the price. We also know how many days on market, the stock. We can tell straight up what suburbs are starting to move before they have already moved, and then people catch on. A lot of people call it hotspot, but the thing about hotspots is that it's already moved. It's moved like good 10, 20, who knows, you just guess how many percentage points, but you've already lost out. Once you sort of start getting into that market, you've already lost a certain amount. So that's where we use the data and our knowledge behind where we think and where we've got the data to say, look, this is what the suburb's actually doing. Historically, this is what every other suburb's done when we hit these metrics. There's no reason why it wouldn't change. A lot of it's got to do with infrastructure, which Vic is pretty big on at the moment. Different zoning, activity zones, things like that.
So sometimes people joke, don't just chase the hotspot or copy other people's homework. Today's hotspot is tomorrow's no spot. That's
a good way of looking at it. The main thing as an investment, we purchase for investors to build their wealth. So we want to maximize that. We don't want to put them in a hotspot where we know it's peaking. Get another, who knows, another 10% or something. Nothing's guaranteed. There's certain things about hotspots and areas. There's a lot of buyers agents, as you alluded to before, a lot out there now. They can actually go into smaller areas, much smaller regional towns. They don't have huge economies. The economy might be a little bit of mining, a bit of tourism, some small stuff, but nothing really major to keep that suburb going on the up. It's certainly got no infrastructure going in there. There's those macro points of view of where that's part of our data set where we make sure that those things are actually happening. A lot of buyers agents can go in there and advise their clients to buy up. There's a couple of thousand people in the town, that's going to move the needle a big way. And so that tells people, the suburbs, it's hot, it's growing, it's huge. But before you know it, it's going to stall when the buyers agents move on into different areas because it doesn't have those economies to drive and keep driving the prices. It doesn't have the demand. The property stagnate and you can't redraw your equity and you can't get that growth nearly as quickly as what you intended to do. Sometimes we see customer, unfortunately, if we do the valuation again, the value actually go down and couldn't even cover the mortgage. Like he said, 30 years long, the banks don't review. Put you in a pretty hard spot and your serviceability goes down and
become a hard spot. Yeah. That's just like
a hard spot,
10 years ago. So what about Queensland? Is Queensland too hot now, Bryan?
Queensland's been going on a tear for quite a while. There is still data on certain spots in Queensland to say that we think they're going to keep going. They did come from a low base. There's a lot going on into Queensland, including infrastructure, the game. They've got a pretty good government up there now. There are areas that still have a bit of life in them.
Final question, Bryan. If someone is standing where you were years ago, they got good income, thinking about property market or property portfolio seriously, what's the one lesson that you want them to hear?
You need to do something. You need to act. It's no good sitting on the theory and saying, well, this is my plan for the next 10, 15, 20 years. This is what I want, not acting on it. That'll be one of the most important things is acting on data. There's no point in just sort of sitting there. Circumstances can change in people's lives. That's the risk that's clearly there. If you don't act now, historically, market's always running, and most of the time it's running forward. That's the beauty of real estate. Historically, it moves upwards. It's not a beautiful trajectory, but the trend line is usually up. As a matter of fact, I think back in 2009, the GFC, Australian land prices in some capital cities only really lost 8 or 9% as a maximum. You've got to act on it now, otherwise you're just closing that gap of opportunity.
Just like Tony Robbins say, take massive action.
You'd
rather be in the game than watching and hear about other people's story. You quit a job, remove the safety blanket.
Well, you don't have to go all in like I did in that sort of fashion, but you need someone with astute guidance to guide you through getting that property and not putting you at risk of the market, putting you in a hot spot and then risking the valuations are going to stagnate. That's as good as not getting into the market when you think about it, because if you buy at the top of the cycle and it's going to sit flatline for the next 10 years, you can't do anything with that property. You can't draw the equity. Hopefully be positive cash flow. It may not be. It's stagnated. So we don't want to put anyone in that position, hence why we use a lot of data and a lot of knowledge. If it's not data, it's just opinion.
Thank you for Bryan Green today, from 10 townhouses to hard-earned wisdom, and now a buyer's agent on your side. And if you want to get connected with Bryan, we'll put his email and website at the end of the subscription. Thank you.
Cool.
Thanks, Bryan.
Thanks for having me.
All right. We're going to do this one as well. And that's how we do that. Here's some case study.
Yeah.
Yeah.